Get ready, crypto enthusiasts, because the market is absolutely on fire today. We've got seismic shifts and major moves happening faster than you can blink. From record-breaking rallies to dramatic corrections, the landscape is changing by the minute. You absolutely do not want to miss these unmissable updates that are setting the stage for what's next. Stick around, because Bitcoin Bulletin is bringing you the inside scoop on everything you need to know, right now. First up, a massive spike and a sharp fall in Bitcoin prices. Then, we're diving into the current state of Bitcoin and its market dominance. After that, we're exploring how institutional trading is completely transforming the crypto sphere. And finally, we'll look at a huge Treasury play that's shaking up the industry. Don't go anywhere. Make sure you like, subscribe, and hit that notification bell so you never miss a beat. Bitcoin's wild ride. A $124K spike, and a 1B liquidation frenzy. Bitcoin's volatility was on full display this week, as the digital asset surged past $124,000 before a sharp correction, triggered by hotter-than-expected Producer Price Index, PPI, data. This dramatic swing led to over $1 billion in liquidations across the market. The price action highlights the cryptocurrency's sensitivity to macroeconomic indicators and the risks associated with leveraged trading. Bitcoin experienced a significant price surge midweek, briefly touching a new all-time high of $124,517. This upward momentum was fueled by growing optimism surrounding macroeconomic conditions and increased adoption of Bitcoin ETFs. However, the release of the U.S. Producer Price Index, PPI, data on August 14th proved to be a major turning point. The data came in hotter than anticipated, signaling persistent inflation concerns and dampening expectations for imminent Federal Reserve rate cuts. In response, Bitcoin plummeted from its peak, falling below $118,000 within minutes. This rapid price decline also impacted Ethereum, ETH, which dropped from $4,791 to under $4,500. The immediate aftermath saw over $1 billion in leveraged positions liquidated, underscoring the fragility of highly leveraged trades in such volatile conditions. The overall crypto market capitalization saw a modest increase, rising from $3.97 trillion to $4.04 trillion for the week. At its peak, the market cap reached nearly $4.28 trillion, buoyed by strong performances from Bitcoin and other major cryptocurrencies like Ethereum, Solana, and Dogecoin. However, the PPI data served as a stark reminder of the market's susceptibility to macroeconomic news, reversing the positive trend and exposing underlying vulnerabilities. The elevated PPI figures reinforced fears of sustained inflation, potentially pushing back the timeline for any Federal Reserve interest rate reductions. This macroeconomic backdrop has led to increased caution among investors, who are now closely monitoring central bank policies and economic data for further direction. The event also highlighted the critical role of algorithmic trading and automated liquidation mechanisms in amplifying price movements during periods of intense market fluctuation. Despite the midweek sell-off, Bitcoin managed to close the week around $118,800, marking a slight gain of 0.2% from the previous week. However, the intraweek volatility revealed structural weaknesses within leveraged trading environments, with analysts pointing out the vulnerability of both institutional and retail positions to sudden macroeconomic shifts. The rapid liquidation cascade demonstrated how quickly market sentiment can turn when economic data deviates from expectations. Ethereum, meanwhile, ended the week with a more positive trajectory, posting a 4.4% gain despite the broader market correction. Several other top 20 altcoins also registered marginal gains. In contrast, XRP experienced a notable downturn, closing the week at approximately $3.12, a decline of 6.7%. This underperformance has tempered some of the bullish predictions for XRP, which some analysts had forecast to break the $4 mark. Adding to the market's complexity, Asymmetry USDAF, USDAF, a stablecoin-like asset, saw its price decline by 1.1% over the past 7 days. Its market capitalization and fully diluted valuation are both reported at BTC 976554, indicating that its entire supply of 12 million tokens is already in circulation. As macroeconomic data continues to dictate market sentiment, investors are keenly awaiting future reports, emphasizing the importance of robust risk management, especially for leveraged positions, to mitigate the impact of cascading losses during liquidity events. Hold on tight, because the market's reaction to this data is far from over. Next up, we're breaking down the current state of Bitcoin and its growing market dominance. Bitcoin dominance, market trends, and global adoption insights. Bitcoin has recently surpassed the $123,000 mark, a significant achievement driven by robust institutional investment, consistent inflows into spot ETFs, and strategic corporate treasury allocations. This sustained growth reflects a growing market confidence in Bitcoin as a key financial asset, bolstered by supportive U.S. policies. Bitcoin's market capitalization currently stands at approximately $2.34 trillion, accounting for a dominant 59.04% of the total cryptocurrency market. Despite a recent dip in trading volume, the overall steady upward trend suggests potential for further expansion. The surge in Bitcoin's value is largely attributable to increased institutional adoption. Major financial entities, including hedge funds and sovereign wealth funds, have been actively increasing their Bitcoin holdings. This trend is exemplified by Michael Saylor's company, MicroStrategy, whose Bitcoin portfolio recently reached an all-time high valuation of $77.2 billion. Such aggressive purchasing strategies significantly bolster market sentiment, providing crucial price support and fostering innovation within the cryptocurrency sector. In regions experiencing severe economic instability, such as Argentina, stablecoins like USDT and USDC have emerged as vital tools for financial stability and transaction capabilities. Amidst hyperinflation and significant devaluation of the local peso, many Argentinians are turning to stablecoins to protect their earnings from currency depreciation. The practice of receiving salaries in stablecoins is particularly noteworthy, offering a shield against the erosive effects of inflation. On platforms like Bitso, USDT transactions represented 50% of all crypto purchases, with Bitcoin making up only 8%, underscoring the immediate demand for stable value storage in economically challenged areas. Fintech companies across Asia are capitalizing on Bitcoin's rising price by developing and offering crypto payroll solutions. These innovative services provide rapid, borderless payment options, catering to a modern workforce increasingly seeking financial independence and flexible compensation methods. By integrating blockchain technology into payroll systems, these firms can facilitate near-instant payments in cryptocurrencies, including Bitcoin and various stablecoins. This not only helps to reduce foreign exchange fees, but also enhances employee satisfaction, particularly among younger demographics who are more inclined towards digital assets. The growing adoption of crypto payroll in Asia mirrors a wider global shift towards greater financial inclusivity and alternative payment structures. However, the adoption of Bitcoin payroll services by European small and medium-sized enterprises, SMEs, is currently hampered by significant regulatory complexities. The evolving regulatory landscape in the European Union, encompassing frameworks like MiCA and TFR, imposes stringent compliance and reporting obligations. Many SMEs lack the internal resources and expertise to navigate these intricate regulations, leading to increased operational costs and potential compliance risks. Furthermore, adherence to anti-money laundering, AML, regulations and managing diverse tax implications add further layers of complexity, often necessitating reliance on specialized third-party service providers for compliance and risk mitigation. The future trajectory of crypto payroll solutions is intrinsically linked to the continued maturation and stability of Bitcoin. Sustained institutional investment is expected to further legitimize digital currencies, thereby facilitating the broader adoption of crypto payroll systems. As more companies recognize the advantages of offering crypto salaries, from attracting top talent to promoting financial inclusion. And as regulatory frameworks become more defined and accessible, the implementation of compliant crypto payroll solutions will become more feasible. This evolution has the potential to fundamentally reshape global salary structures, positioning Bitcoin and stablecoins at the forefront of future compensation strategies. But is this institutional surge the whole story? We're about to find out. Next, we're diving deep into how institutional Bitcoin trading is revolutionizing the entire crypto landscape. El Salvador leads the charge. Banks embrace Bitcoin, transforming global finance. In a move that could redefine the future of finance, El Salvador's groundbreaking legislation in August 2025, allowing investment banks to hold Bitcoin, has paved the way for major financial institutions like Standard Chartered to enter the Bitcoin trading space. This development signals a profound transformation in institutional Bitcoin trading, with significant implications for the global crypto market and the very nature of digital assets. El Salvador's investment banking law represents a bold step towards integrating traditional finance with the burgeoning digital asset economy. By permitting private banks to engage with Bitcoin, particularly targeting discerning investors, the nation is not just adopting a new asset class, but is actively shaping a new economic identity. Juan Carlos Reyes, president of the Commission of Digital Assets, CNAD, has highlighted that this law enables banks to operate in a manner so aligned with conventional banking practices that it is poised to attract substantial global capital. This strategic maneuver aims to elevate Bitcoin's status and encourage broader institutional acceptance, thereby reshaping the regional financial architecture. The entry of global financial giants like Standard Chartered into institutional Bitcoin trading is a pivotal moment for the cryptocurrency market. Their active participation lends significant credibility and market value to Bitcoin, fostering a more regulated and secure environment conducive to large-scale investments. This shift is crucial for overcoming the volatility concerns that previously deterred many institutional players, creating more accessible pathways for mainstream adoption. The involvement of established banks as trusted intermediaries provides institutional investors with greater confidence to explore and capitalize on Bitcoin's potential without the apprehension of regulatory uncertainty or market manipulation. A wave of U.S. regulatory adjustments is also contributing to a more favorable climate for crypto investments. This easing of restrictions is seen not merely as a positive sign, but as a direct invitation for banks to innovate and develop new financial products centered around digital asset management. Investors are keenly observing these changes, anticipating a significant influx of institutional funds that could drive substantial price appreciation for Bitcoin. Historically, similar regulatory shifts have preceded major market rallies, leading many to believe that a resurgence is on the horizon, not just for stablecoins, but for the entire cryptocurrency ecosystem. In this rapidly evolving financial landscape, institutional investors are carefully strategizing, balancing caution with palpable excitement. El Salvador's investment banking law mandates a minimum capital requirement of $50 million, positioning the nation ahead of established financial hubs like Switzerland in its efforts to cultivate a pro-crypto environment. While these stringent entry barriers might deter smaller participants, they also serve to enhance market stability and attract significant, serious capital, thereby bolstering overall confidence in the crypto space. As institutional investment gains momentum, the dynamics of crypto trading are rapidly shifting. The trend towards centralized Bitcoin trading, spearheaded by major banks, raises pertinent questions about the preservation of Bitcoin's core principles of decentralization. In this complex environment, emerging startups face the challenge of navigating stringent compliance requirements and increased regulatory scrutiny, all while managing inherent market volatility. The convergence of traditional finance and digital assets presents both unprecedented opportunities and significant challenges for all market participants. El Salvador's bold legislative initiatives, coupled with the strategic entry of major banks into institutional Bitcoin trading, herald an exciting new era for the crypto ecosystem. As regulatory frameworks adapt to accommodate digital assets, a plethora of opportunities are emerging for both individual investors and large institutions. The ongoing dialogue between decentralization and centralization will undoubtedly shape the future trajectory of Bitcoin and the broader crypto market. Staying informed and managing risks effectively are paramount for anyone operating within this dynamic domain. In essence, El Salvador's forward-thinking financial policies represent a significant leap forward, potentially ushering in one of the most transformative financial revolutions of our time by inviting astute investors into a revitalized crypto landscape. But is this institutional shift sustainable, or just a temporary surge? Up next, we're examining a massive Treasury play that could redefine industry dominance. BSTR's strategic Bitcoin Treasury move, a bold play for market supremacy. In a significant development shaking up the competitive landscape, BSTR has announced a massive $2.1 billion play involving Bitcoin Treasury allocation. This strategic maneuver positions BSTR to potentially gain a substantial edge over competitors like MARA in the ongoing race for institutional dominance within the cryptocurrency sector. The decision by BSTR to allocate a considerable $2.1 billion to Bitcoin Treasury holdings is a clear signal of its long-term conviction in the digital asset's potential and its strategy to leverage Bitcoin for institutional growth. This move is not merely about holding an asset. It's about integrating Bitcoin into the core financial strategy of the company, aiming to enhance its balance sheet and potentially unlock new avenues for revenue and market influence. By securing such a substantial amount of Bitcoin, BSTR is making a bold statement about its commitment to the evolving digital economy and its ambition to lead in the institutional crypto space. This substantial treasury allocation can be viewed as a direct challenge to competitors, particularly those like MARA, who are also actively building their presence in the institutional crypto market. The scale of BSTR's investment suggests a strategic intent to capture a larger market share and establish itself as a key player. Such a move can influence market dynamics, potentially forcing competitors to reevaluate their own strategies and possibly leading to an arms race in acquiring and holding Bitcoin as a strategic reserve asset. The implications for institutional adoption are significant, as more large-scale players entering the space validate Bitcoin as a legitimate store of value and a critical component of modern corporate finance. The timing of BSTR's announcement is also noteworthy, coming at a time when institutional interest in Bitcoin continues to grow, driven by factors such as the approval of spot Bitcoin ETFs and increasing regulatory clarity in various jurisdictions. Companies like BSTR are likely positioning themselves to benefit from the anticipated influx of capital and the growing acceptance of digital assets within traditional financial systems. By proactively securing a large Bitcoin position, BSTR is not only hedging against potential future price increases, but also signaling its readiness to capitalize on the broader institutional adoption wave. The $2.1 billion allocation represents a significant portion of BSTR's overall financial resources, underscoring the high stakes involved. This move carries inherent risks, given Bitcoin's well-known volatility. However, the potential rewards, including enhanced financial stability, a stronger market position, and the ability to offer new services or products backed by Bitcoin reserves, appear to outweigh these risks in BSTR's strategic calculus. The success of this play will likely depend on BSTR's ability to manage its Bitcoin holdings effectively, navigate the evolving regulatory landscape, and capitalize on the opportunities presented by increasing institutional demand. Market analysts are closely watching BSTR's strategy, with many viewing it as a bold and potentially game-changing move. The impact on competitors like MARA will be keenly observed, as BSTR's actions could set new benchmarks for treasury management in the crypto industry. This development further solidifies the narrative of Bitcoin as a legitimate institutional asset and highlights the intensifying competition among companies vying for leadership in this rapidly expanding sector. The broader market reaction and the long-term implications for institutional Bitcoin adoption will unfold in the coming months and years. And that brings us to the end of our top stories for today. Make sure to join us next time for more breaking news and in-depth analysis. That's a wrap on today's market movers. Bitcoin saw a massive spike, then a sharp fall on inflation data, while its market dominance remains strong. Institutional trading is reshaping the crypto sphere, and BSTR is making a huge $2.1 billion play for dominance. Don't miss out on any of the action. Hit that like button, subscribe to Bitcoin Bulletin, ring the notification bell, leave a comment with your thoughts, and follow us on all our socials so you stay ahead of the curve.